Hello, everybody. Welcome to today's webinar brought to you by Bursa Malaysia and managed by our company LifeChamp. Our webinar title today is Critical Mistakes that are high risk to your portfolio. So my name is Shen Chu. I'm the moderator for this webinar. Now today we are going to talk about 3 mistakes that are silently hurting investors at every level. And more importantly is what you can do to protect your portfolio before it is too late. So before we begin, here is the disclaimer. Whatever we share in this session is only for educational purpose. In no way that we give any recommendation for you to buy or sell any listed securities that we mentioned here. If you decide to make any investment decision, you are solely responsible for all your investment risks. Now, allow me to briefly introduce our speaker today. He graduated with a bachelor degree in mechanical engineering and has more than 20 years of experience working in the oil and gas industry, from sales to his last role in regional supply chain management. He started his active trading journey in 2014 after the completion of the Beyond Insights program. Later on, he felt that others would and should benefit from the very same program that he took, so he took up coaching and training responsibilities to help others. He believes that he will be able to help others since he had once been in the same shoes. Since 2017, he has been coaching over 1,000 students in the foundation programs, and currently he is also one of the Beyond Insight Investment and Trading Education program managers, helping with program development and enhancement, particularly in the intraday trading course. It is none other than Mr. Koot. Koot, how are you today? Yeah, you're on mute.
All right. Sorry, I was on mute. Yes, thank you.
Yeah,
Yes, okay.
fantastic. We can hear you loud and clear now. So I will just stop sharing my screen and hand over the control to you.
Okay, all right. Thanks, Shane. So let me take over the screen right now. Okay, so you should be able to see my screen.
Yes, perfect.
Okay, can. All right, yeah. So for today, I want to cover the critical mistakes which are damaging to your portfolio, to your wealth, and also to your, to whatever that you're holding. Okay, but before that, I'd like to know, okay, as usual, I'd like to understand the kind of audience that we have so that I can tailor my speed and also the depth which I want to cover with you. So, Shane, can you pull out the poll to understand the audience better? Okay, all right, yeah. So on your screen, you should be able to see the BI poll, Beyond Insights poll. So there's a few questions here. Let me just see here. 4 questions here, just to understand where you're coming from and what sort of experience you have so that I can fine tune what I'm covering to you. All right. So yeah. So could you please fill up the poll? It's a very fast, very few questions only. Right. Okay. So Shane, you just tell me when the poll has been filled up. Yeah.
Sure.
Okay.
Yeah, maybe I'll just give an extra,
Uh-huh.
20 seconds, okay, before we close the poll.
Yeah. So do fill up the poll so that I can understand the kind of experience that you have. These are not confidential questions, so feel free to answer them.
Okay, yeah, let's do it one
Mhm.
last 5 seconds before we close the poll. Okay, if you have not submitted, please click submit. Okay, I think let's end the poll now.
Okay, all right. Okay, so where do I see the results then? Okay, I can see the results. Okay, so I am showing the poll. Can you see the results on the screen as well?
Yeah.
You can, okay, all right. Yeah, so from what I can see, okay, so first one is in terms of experience, I can see there's a wide spectrum, quite equally spread from beginners to, well, pretty veterans traders as well, traders and investors. Right, so that's good. Then most of you are, well, you have intermediate knowledge in the market. Okay, very good. We do have some beginners. And mostly most of you trade the Malaysian or invest in the Malaysian market. Well, quite a number of you actually invest and traded in the US market as well and Singapore. And yep, okay. So on the instrument type, most of you are into Forex, into stocks, some into Forex, commodities, and crypto. All right. Okay. So that tells me the kind of spectrum of audience that I have. All right. So first, uh, this topic. Okay, this topic is okay. So why do we cover this topic? So I know that many of you, as you trade and as you invest, sometimes you do have good success, right? You can see your portfolio grow very well. But then other times when things are bad or when there's a certain mistakes, whatever that you have gained, it's actually lost back to the market. Okay, so how many of you feel that way? Okay, hang on, let me just go. Yeah. How many of you feel that way? Okay. Yeah. So you have some success, but then when things don't do well, everything is all reverse. Okay. Sometimes back to zero, or sometimes even go into negative. Right. So here, like the point which I've got here. So the portfolio should be growing. Yeah, you do. You do have good trades. You do have good success, and okay, it should, but it's not. All right. And then so it's not in terms of your stock picking skills. You have good. You do make good decision. Okay, but then the threat to your portfolio is actually what happens after you buy. All right. Yeah, so okay, let me just go one slide back. So with that, I want to cover these three main mistakes which we have seen among the public in our public talk to the audience like this group and also to all the webinars and seminars that we have been to, and also among our students. So students come to us, they want to learn, and when we discuss with them, hey, what happened? Why do you want to learn? We hear of these very common mistakes that they have do. Yeah, so through our courses with them, they learn to understand all this and also what to do. Okay, what are the right things to do? Okay, so let me go point by point first. All right. So anyway, in Beyond Insights, we talk about the STPM method, okay, or the framework. So the first S refers to select the right stocks. Time, okay, selecting the right stock is not the only thing. You also need to know the time. But the part which we are going to cover here today is the protect. After you have bought, okay, or entered into position, what do you do to protect whatever that you're holding? One. Second is what do you do to protect your portfolio? All right. Yeah. So it's covered under this framework of STPM. Okay, now let's move on. All right, so first common mistakes that I see or we see among the market traders and investors, average down. Okay, so for some of you who are new, you have never heard of this. Okay, let me show you this example. Let's just say, for instance, the stock comes down, comes down to the price that you want to buy, 450. So you buy 10 lots. 10 lots is 10 multiplied by 100 units, so that's 1,000 units. Then price goes up, you're very happy, price went up to 480. Right? But then after that, price starts falling down, fall down and fall down, and then fall down to $4. Okay, and you're still holding it. Right. So instead of holding it, okay, and make money, now you are in the red. You are losing money already. Okay, so what some investors and traders do is, okay, they have this method which the market or the industry call average down, which means to say, now as you are losing money, the idea is, why don't you buy another time at this lower price? So the first time when you bought your initial price you bought was 450. Now as the price dropped to $4, you buy another time. All right. Sometimes you buy the same number of units. Sometimes they buy less. Sometimes they buy more. Okay. But the main idea is you buy, yes. All right. So if you buy the same number of units, now your average price for this transaction will be 450 plus $4 divided by 2, 425. So you see this this highlight area which I have marked here. So instead of your buying price at this level, now it is as if your buying price is at somewhere in the middle. All right. Okay. Yeah. So that's what we call average down. And sometimes as the price goes even further, then there are some investors or trader who buy the third round, third time that they buy. So first time was this one, 450 drop to $4, you buy second round, then you average. Then sometimes it goes further, they buy the third round or even the fourth round. All right. So there's no stop to how much or how many times you can buy. Okay. So what is the goal of doing this is if you bought it at 450 and you buy at $4, now your average price is like what I've mentioned, now becomes 4.25. Okay. Now let me show you one calculation table here to share the idea. Okay, so let's just say, for instance, uh, based on that one, when you buy at the first buy that you have got, buy at 450, so your average price is 450, and you buy 10 units, right? Yeah, so let's just say, let me look at the slide. Okay, so at the point when you buy at 450, okay, at 450, of course, break even, you don't lose. Okay, then when let's just say, for instance, price drops down to $4, now you lose $500. Okay, now you lose $500. So the strategy is you buy again at the lower price. So with the buying again at the low price, your average price, like what I've shown on the chart, is 425. And instead of buying 10 units, now you have 20 units. And you can see here, 10 lots at 450 and another 10 lot at $4. Okay, so at $4, your loss is the same. Okay, now the investors and traders, what they hope is if the price recover back to 450, okay, let me just put 450 again. Okay, 450. Now you can see those who only buy one time, all right, they go back to break even. They no lose, no gain. Okay, neutral. But those who bought two times, can you see? Their decision now makes money for them. They are in positive already. And if the price goes up to $5, they start making way more than those who bought. All right. So that's the theory. So that's the reason why they do all this. But they are just looking at the upside, all the good rosy hopes that they have. What if the price now dropped to 350? Okay, 350. Now you can see if they are wrong and the price still continue dropping, those who only bought one time, okay, they lose money, yes. And those who bought another time, second time, average down to cover back and to average at higher level for 25, they lose way more now, 1,005. And all because they are holding 20 lots. And of course, if it goes down to $3, imagine now it's coming to double of whatever they have lost. All right, yeah. So this strategy, okay, going back to the strategy, this strategy works if you are right and the market actually goes up. Okay, market actually goes up. Okay, let me change to green color. If the market actually goes up, okay, if the market actually goes up. If you are wrong and the market goes down, then gone. Everything that you did to protect your wealth and your position and things like that, they now go against you, right? So that's averaging down. Okay, but then some of you will say that, hey, yeah, okay, I see that the price has already gone down very low already, right? So now it's actually the time to buy. And I cannot exit because if I exit, I will lose money. So my only choice is to buy another time to average it down. Okay. Now just think of this. You were wrong here in the first place. All right. You were wrong here. Okay. That's why. Okay. Oops. Sorry. Okay. You were wrong here. That's why the price went down. What if you are wrong here again? All right. What if you are wrong here again? Can you be wrong here again? If you were wrong the first time, you could be wrong the second time. And in what we always teach our students, always look at the trend. What is the trend? The price is actually heading down. And you're buying when the price goes down. What is the next direction? Price can come down even further. All right. So for our students, we always trust the trend. Okay. If the trend is coming down, don't buy. So if you're buying when it's going down, then you are putting yourself at high risk of compounding your losses now. Okay. Yeah. So that's averaging down. So I hope I'm telling you, and you understand this is the danger. So feel free to type any questions into the Q&A or ask in the chat. All right. I will answer questions if you have. So now what you should do is you can average up. All right. Let's just say, for instance, instead of stock price goes down, don't go down. Now it goes up. Then it's okay. Those who are doing trend trading and things like that, or buy on momentum, yeah, they do buy as the price goes up. Okay, that is a okay strategy. And so you should not add when it's going down. In short, we are saying buy on strength. Because the stock has strength, you can add. But if it is weak, please do not add. All right. Yeah. Then the other point is okay, so the market is actually testing your decision, whether you have bought this and whether your decision is correct. If your decision is failed, that's why the price is coming down. You shouldn't be, or you shouldn't be adding anymore. Your stock selection has already failed the test, is it? For that particular stock, it has already failed the test. So don't add to it. Right? Yeah. So then the last point is, yeah, you need to manage or have good risk management. So when you average down, your risk will actually increase and compound, like what I've shown you just now in the table. All right. But then if you average up, okay, depending on which strategy you use, you can actually manage so that your risk at the beginning is also the same as the risk at the point when you want to add your position. Okay, so you can actually manage that. All right. So in short, never average down. Okay, never average down. Okay, you can average up. Yes, good. Don't average down. Okay. Dollar cost averaging. Okay, so from Andy, yes, Andy. Some calls it dollar cost averaging. All right, but that is also a term which is created by the market. So you can call it dollar cost averaging, but I hope when you do the averaging as the stock performs in your favor, not when it doesn't perform in your favor. So like this point number 2, if the stock fail the market test already, do not add to it. Okay, clear? Anyone has questions? All right. So if not, then let me move on. The second issue or second mistake, which a lot of traders who have not learned the proper way, they will make this mistake, is no clear position sizing. All right. Okay. So when they buy, or enter into position, first point, they do not have a predetermined trade size. Okay. There are many strategies to determine what is the right trade size. There are some which is based on risk, some which are based on allocation, and so on. All right. But those who do not have any, all right, they do not know, do not even know how much to buy. One common calculation for beginner traders or investor is, if I have my capital of 10,000 or 5,000 or whatever value you have for your original capital, you take the whole thing and put it into one single stock. All right. They put it into one single stock. No diversification at all. So that one is a total no. Never ever do that. Something happened to that one single stock, your capital or your wealth or your whatever, your portfolio is at total risk. All right. Yeah. Okay. So that's one. Okay. No idea. Don't know how to calculate. All right. Second one is now confidence over calculation. Sometimes you know how to calculate, but then just for this particular stock or particular ticker or particular counter, you feel so confident over it. You have good news, the chart looks nice, there are people who tells you, hey, it is good, or even your reminder or broker tell you, hey, this one is a sure win. Or you hear some news from somebody and this is a confirmed, verified, leaked news. So you're so confident and normally you put only, let's just say for instance, 200 or 500 or whatever value, or now you put way more inside there. So you have absolute confidence and that has overridden your calculation. All right. Yeah. So with that, Then this is also what we call no clear position sizing, no good risk management. Okay, the other term is also risk management. No good risk management, no money management. You are actually using your emotions, right? Yeah. Okay. Then the other one is okay. So okay, back on this one. So let's just say, for instance, if you have three stocks, you feel confident, you put more money into stock A. You feel less confident, you put less money or less portion of your portfolio into stock C. All right. B is the standard one. Okay, that one is as per your calculation. All right. So, and you hope things will go well for you. So stock A make more money. Stock C, you have confidence, you don't think it's going to make money. What if the result actually turn out the other way around? Okay, stock A actually lose. Okay, you lose much more in stock A. The stock went down 20%. Stock C actually went up. Okay, so because of that, you put so little into stock C, you make very little. You put so much into stock A, you lose much more. So this also puts your portfolio management into haywire, into jeopardy. All right. So for us, for traders who have a proper system and strategy, we divide our portfolio by risk equally. All right. To us, every single stock in our portfolio has equal chance of going up and going down. So we balance out the risk and our exposure there. Okay. All right. Yeah. So same thing for point number 3 as well. Okay, so at this point, I will just pause. Okay, my question to all of you is, how many of you feel that you have a proper risk management and can calculate and know how to determine your position size very well? How much to buy for everyone? You can type, yeah, me. Okay, if you feel confident, just type me. Okay, if you don't feel confident, you just put an X there. Okay. Yeah, feel free to type if you feel free to type or if you don't feel okay. So I see one X, a few of you X. All right. So my advice to you is please learn on this. Okay. There are books you can learn, there are courses you can join. You can also come to Beyond Insights and learn about this. So we teach students how to determine all this. All right. Yeah. But please, whatever you do on your own or you go to a course, please make sure you are clear how to determine this. Otherwise, like what I've said, okay, you put too much into something that actually goes down, and you put too little and that actually goes up. Your risk management is not properly diversified. Okay, all right, yeah. So please, okay, please go and research about it. Go get help. Go get yourself learn on this. You can join courses. All right, yeah. Okay, then let me move on to the next. Okay, yeah. So what happens is, okay, so this one I've actually mentioned. So what happens if you don't have proper position sizing? The good one may not make enough money to cover all the one that went down. As you can see here, or this one you put 50% risk. This one you put 300% risk. This one put 100% risk. It's all haywire everywhere, and all determined by your feeling, your emotions. Then your result will not be consistent. Maybe overall, you are a good trader, okay, or a good investor. You have selected all the proper ones, but then some win, some lose, and all the losses that you have got is actually much bigger than your wins. So that, like what I've said earlier, it actually put your portfolio to risk. Okay. All right. Yeah. So, okay, now let me share. Now, so from the industry, among professional traders, professional hedge funds, and all those who have learned the proper way, what we do is we define the risk per trade. Okay, what does that mean? That means, let's just say, for instance, I want to buy into stock A. All right. So if I want to buy into stock A, from the beginning, I already know that if stock A goes down by $1, 1 ringgit, how much will I lose? Stock A goes down by 2 ringgit, how much will I lose? Okay, that's the first thing. Second thing is, I also know how much risk am I willing to risk. Let's just say, for instance, my capital is 5,000 ringgit. All right. Then I'll tell myself, okay, for my capital, I want to buy a few stocks, and every stocks I want to put to risk. Okay, we don't like to use the word lose money. Okay, you haven't lose yet. It's just a risk. Okay, at the point when you buy, it's just the risk. I want to have a maximum risk of maybe 50 ringgit. Okay, 50 ringgit per stock only. So which means to say I buy this stock. If the stock goes down, goes down, goes down, when I lose 50 ringgit, I will chop it. Okay, I will exit the market. So my maximum risk and loss for this stock is only 50 ringgit. All right. Yeah. Then from there on, then we determine, okay, how much to buy based on this risk calculation, the one above. Yeah. So two steps. Define your risk per trade, and then you decide what is your position size. Okay. So normally out in the market, the professional people, okay, the professional companies, imagine this, okay, they only risk maximum of 1 or 2%. And from what I gather, all the books that I've read, they actually lose less than that. They lose, okay, they not lose, they risk way less than this, right? This is the standard textbook advice, risk maximum 1 to 2%. Okay, but actual professional hedge funds and all those things, they actually talk about 0.5% or even 1/4% or even way less than that. So imagine if a fund, okay, hedge fund or whatever, they have 1 billion ringgit. All right, that 1% will be like 10 million ringgit just in one company. So they actually trim this risk to even less. All right. So how many of you find that surprising? You thought that a professional company, or they dare to risk more, risk 10%, 20%, 30% into the stock, right? Yeah. So are you surprised to hear that? Professional investors, traders, and hedge funds, they actually trim their risk to way, way even less, 1% or way even less than that. So this is what they do. So next time when you are out in the market, you want to buy, please look at your risk. Do not be so gung-ho. Know that the professional people are way, way more wary of the risk than you, and so should you in the future. Okay, all right. Any questions on this before I move to the third point? Nobody? Everyone understand? Okay, I can see your chat here. So I can monitor your chat. I can answer in real time. Okay, so if no questions, good. Let me move on to the third idea. Okay, now this one is very common. We always, when we talk to people we meet in seminars and webinars, then they will tell us, "Oh yeah, Koot, my portfolio not doing very well, but it's okay. All right, I've got these stocks which I bought. Now the price has dropped half already, but it's okay, no problem. It will come back, so I will still be holding it." Okay, so this is the belief that it will always come back. Right. So let's hear this. All right. So why do people have this belief? Because the market has always recovered. All right. So like they say, okay, as far as anyone can remember, market always recover. Okay, we had 1997 Asian financial crisis. Okay, a lot of people lose money. Okay, but after that, look at what happened to the stock market. It actually recovered. Okay, let me just see if I can put that out. Uh, yeah, let's see. Okay, all right. So this is FBM KLCI, which is our Bursa. Okay, let me set it to months so that we can see what happened here. So you can see 1997 Asian financial crisis. Wow, dropped a lot. But after that, look at it. Okay, look at it. What happened? You see, it has always recovered. All right, so that's the Asian financial crisis. Then the dot-com, I think this is the dot-com, year 2000, dot-com drop. After that, also recovered. Okay, after that, also recovered, this one, year 2000, also recovered. Then the US subprime crisis. Okay, it affects US, but the spread and the crisis also spread to many, many other countries as well. Look at it, drop. How much did it drop from the high, the absolute high of this one? Okay, it dropped around 43%. So imagine 43% of the index value dropped, right? And after that, yes, it does recover back again. Then what else? COVID is 2020. Okay, let me just see. COVID dropped. So from the high in 2018, COVID, to the lowest point, it actually dropped 36%. Okay, but still, it recovered here. All right. Okay, clear? You remember all these crises? Okay, and because of this memory, okay, all of this, people always remember, oh yeah, the market will always recover. And also because of that, there is this belief in among the traders and investors, the sellers were the losers, the keeper were the winners. Okay, so let me show to you. All right. So let's just say, for instance, okay, in the Asian financial crisis, if you had in your position then, and when the index dropped down, your stock price drops down. If you sell, you lose. Okay, you lose. All right. If you didn't sell and you hold it back all the way, you win. All right. So the sellers, to their mind, the sellers were the losers. The keeper were the winners. Okay. Anybody of you believe in that? Come, be honest. Tell me. Anybody has this strategy? Yeah, just hold on. Lose is okay. After that, it will reverse back. Okay, things always U-turn back. Okay, yes, work for you. Okay, all right. Okay, okay. So I see a few of you saying that. Okay, now. Okay, so good point. All right, that's why. Okay, now let me pull this away. Right. Okay, so let me go to the next slide to explain to you. Okay, so there is a flaw in that logic. Okay, first is if you are buying stocks, not all the stocks will survive. Okay, there are cases where stocks go down, doesn't come back, and probably even get delisted or company just go bust. Right? So not all stocks survive. Okay, let me just see. I've got some points here. Okay, right. So okay, anybody knows about? Okay, let me just show you some stocks that are currently still very battered down. Okay, if it triggers some pain point within you, my apologies. But then we want to learn from this. Okay, so first, Astro. Okay, currently still active, trading in the market. Astro, right? From the high of 350. Okay, hang on. The high, okay, around 350 here. Now drop to around 65 cents. So this is a drop. If you can see the word up here, it's a 98% drop. So your value, if you were buying at this point, is now left 2% of your original stock value. Okay. So it is left to 2%. Okay, so that's current one. Okay, then also those who were very active trading during the stock market because there was nothing else to do. All right, you were all locked down, cannot do. You can only turn on your PC and start trading. Some of you may be in top glove. All right, look at what happened to the stock. Okay, price went up very high, nearly $10. After that, dropped down. Okay, once in a while it goes up. Then some of you will, if you were holding it, wow, then you get very happy, hoping that after that you will recover its glory, go all the way up here. But no, it didn't. It went down after that again. All right, so all the major four companies, Top Glove, Kosan, Supermax, and the other one is Harta Lega. All of them have the same pattern. They are still down. Okay, so the lesson to learn is, not all stocks will survive. Some are actually delisted out of the market. You lose it, it's dead. The stock is dead. And some stays depressed for years, like Astro has been falling all the while. Now still very low. Okay, and some actually get PN17 delisted and things like that. Okay, that's the first thing. Now, then some of you will say, hey, but then I remember, hey, index I always recover, right? Okay, so index versus stock, there's actually a big difference between them. Okay, stock is the individual company. Okay, and many stocks make up the index. All right, so for the FBM KLCI or the Bursa index, How many stocks make up that index? Anybody knows? KLCI index, how many stocks are there in the index? Anybody knows? 100? Okay, 30, correct, yes. There's 30 stocks in the FBM KLCI index. 30, yeah? All right, so let me write here, 30 stocks. 30 stocks. Okay, but I mean, but 100 is a very common numbers. Let's just say if you go, I think there are other index goes that has 100 inside, like for instance, the NASDAQ 100, there's 100 stocks inside there. The S&P 500, which measures the top 500 companies in US, that one has even 500, way even more. Okay, but what I want to say is there is a difference between index and stocks. Let's just take this index, okay? There's 30 stocks inside our FBM KLCI index. What that means is we have stock A, B, C, and so on, okay, all the way, okay, until Z and whatever, right? So all of these are stock index. If let's just say, for instance, stock X performs very badly, okay, the stock drops very much. What the index management team will do is they will actually remove this from the index. They'll take this one and they'll drop it. Okay, they'll remove it from the index. So maybe let's just say, for instance, your index is at this level. Last time we were very good. After that, ZAC do very well. And because of that, because of stock ZAC, the performance is very bad. It dragged down the index. Okay. So at this point, then the index management team will say, hey, very bad already. I'll drop ZAC. Okay. ZAC drop. Okay. Drop. Okay. ZAC drop. After that, because it dropped, then they will add another new company. Maybe stock AA. Okay. Stock AA. They add inside. Okay, the next best one, they'll add inside. Stock AA. Then because stock AA is good, then you push the whole average of the index of 30 go higher. Okay, go higher up. So that's why in many cases, the index normally, is more resilient. All right, because there's actually a team of people who monitor the performance and they will add good stocks, they will kick out the bad stocks. It is being managed. Okay, but one single stock is by itself alone. Nothing can save it. It does well, it does well. It doesn't do well, then you just go down. Okay, nothing can save it. All right. So when you say that, hey, you remember the index always do well, Malaysian stock market overall always do well. No, that's the index, not the stock. Stock, we actually have many stocks that is already dead, not doing well, or going to die also. Okay. Then the next thing is, so some of you say, hey, it's okay, I will wait. Okay, I don't need the money. Sometimes you need the money, but then you say, I don't want to buy my new car. I don't want to get married. I don't want to buy my new house. I'll just wait until the market recover. Then I do all of that. So you have waiting cost there. Money tied in this bad stock. Yeah, you could have done better by taking this stock, move it to some other better performer. Okay, let me show you what are the cases here. Okay, let's just say, for instance, okay, this one is an old case. Okay, so in 2022, the Russia hit, in 2022, the whole market has recovered from the COVID. Okay, then I think the price inflation was actually going higher and higher. Then that also is coupled by the Russia hitting Ukraine, fighting war in Ukraine, driving energy and all costs going up. So because of that, a lot of stocks actually went down in 2022. You can see here, January to December, a lot of stocks goes down. So if you were, okay, so this was Maxis. So if you were holding this, you can either hold this and suffer. Okay, let me just calculate how much it is around here. And you suffer around 20% drop in your stock, in your portfolio, depending on what you buy. Or if you see that it has dropped, let's just say, for instance, it has dropped to this level. Okay, maybe you buy here or you own here. When you drop to this level, then you say exit. All right, you exit. Okay, so all this further drop has nothing to do with you because you have already exited from this particular stock or ticker. Okay, so that's one thing you can do. All right. What's the second thing you can do? Now, some of you are very resourceful. So you know, oh, Maxis goes down. Okay, but Maxis is not the only stock in the market. There's many, many other stocks in the market. All right. Could I have traded something else? All right. So what can you trade? Okay. Or could you have bought something else? What if you buy Gamuda? Okay. So let me add Gamuda here. Okay. Gamuda. Okay. So you are very resourceful. You go and check. Hey, Gamuda actually, okay, hang on, I need to move it back to this so that they all start from the same point. Okay, start from the same point, or from here. So Gamuda during that period actually went up by nearly 30% until December, right? So if you hold Maxis, you lose 20%. If you ditch Maxis and you switch over to Gamuda, you actually make nearly 30%. So if you compare the one who switch versus the one who hold, the one who switch actually has 20 plus 30%. That's around 50% more. Okay. Right. So don't need to hold. Okay. You do not need to hold. You can actually switch. You just need to find what are the one that's doing very well and switch over to that. Okay. Any of you practice this strategy, and because of that, you do not hold losers. Anybody? Just like me, yeah. Okay, you can proudly type me now. Okay, any of you who do this strategy? Come on, nobody. Looking at your answers, right? Nobody. Okay, all right. So we have got some. Okay, some says no. Okay, but now you know, right? Now you know. Please do this. Don't hold on to your losers. All right. Don't hold on to your losers. Go and look for better performer stocks. If you do not know how to look for good performing stocks, you can go and research, go and read books, go and do whatever. Or like what I always like to say, like, please join our course, and then you can learn how to look for the good performers. All right. Occasional. Okay, but remember, even if you don't manage to find the good performer, okay, at least you exit from your loser. All right. Then you can save yourself this heartbreak of 20%. All right. Yeah. So the worst thing you can do is hold on to your loser. All right. The next best thing you can do is know your loser, cut and save, and you stay out from the market. Then even better thing is you cut, exit, and you enter into something like this. All right. Yeah. So in Malaysia, you cannot really short. Let's just say, for instance, hey, you know the market is going down. You can't really short per se. But then in some other instruments and some other markets, you can actually practice shorting. So shorting is also another strategy for you to make money while the market is down. Okay, all right. So I see some questions here. All right. So tomorrow must start. Okay, excellent. Okay, please keep that up. So that's the purpose of us as educators and as people who share in webinar. We give you some advice and we truly want you to do well. We want you to follow all this. So write down notes, what you need to do. All right. Or if you need, just go through this video again. You'll be safe in YouTube. Yeah, please do this. You'll change and save your portfolio. So now from Yogendran, will losers go bankrupt over time? High probability. But bankrupt is not what we are afraid of. Losing the money as the stock goes down and down and down, that one is enough to tell us we need to exit. So we are not looking for bankrupt is not what we are saying as the final. Okay, we are not, it's not what we are fearing. Okay, losing is already enough fear for us already. We don't want our stock to go down and we are still holding it. Just like Titanic, okay, Titanic goes down, the people still stays inside the Titanic. No, please don't. Please go up, exit from the ship, right? Okay, let me see what else do I need to share with you. Okay, all right, yeah. So waiting costs. Then, all right. So what to do? Okay, this is what you need to do. So for those who find this is new to you, okay, what to do is before you even enter into the stock, let's just say, for example, to start buy stock A, one buy stock B, one buy stock C. Before you even buy, you must tell yourself, okay, I want to buy at this level. All right. Okay, let me draw for you. I want to buy at this level. Okay, change to blue. Okay, I want to buy at this level. Buy. Okay, B for buy. All right. Of course, like everybody wants the stock to go up. Okay, that's your hope and wish. Okay, which is good. but you must decide at what point do you want to exit. Okay. So in our education, when we teach our students, we call that the stop loss, SL, stop loss, right? So if the stock actually goes down, go down to this level, we must exit. Okay, whether you like it, you don't like it, you must exit. Stop loss. Okay, some of the brokers, I think very few in Malaysia, they offer this stop loss as a feature in the platform, which means to say you buy, when you set a buy price, everybody can set buy price, but you can also set a price level where it will automatically sell for you. All right, so you don't have to monitor the market and say, oh yeah, I buy at maybe 10 ringgit. Okay. Oh, when it reach 8 ringgit, I must sell. Okay. So you don't have to monitor the market every day and look at it. You can set in the system when the price reach to 8 ringgit, automatically it will just exit for you. Whether you are sleeping, working, on holiday, or whatever, it will exit for you. So very few brokers that I know of has this in Malaysia, right, for local market, right? I forgot the name already. Okay. But then yeah, most of them will require you to do the same. Some broker allow you to set an alert or an alarm. When the price reach to this level, they'll send an email to you, or they'll make your app ring or come up with some notification. Then you have to go and manually exit it. Whatever it is, make use of that feature that they have, and then do tell yourself, hey, this level, you must exit. All right. So yeah. Okay. Any questions about this? Okay, I just pause for a while. Okay, so anyone, so for those who are new to this, so I hope you find this useful. Please implement this. Please decide where you want to exit before you even place your buy order. Okay, right. So Mike, okay, so good. I was waiting for that question. How do you set your stop loss? Okay, now that one is, I will just cover at high level. Why? Because that one we do, I mean, we do cover in our courses, but that one needs some time to explain. Okay, first is how do you set your stop loss? There's many different ways, right? Okay, one of the popular way is, let's just say, for instance, some people will just say, oh, I only want to risk 5%. If the stock drop by 5%, then I will exit. All right. Okay, that is the most popular way used in in the textbook and also among a lot of investors and traders. Okay, so you can do that, right? 5%, or sometimes you say 5%, maybe the stock will go down. Okay, let's just say, for instance, it will go down like this, okay, and then go up. Okay, so if you set 5% here, 5% here, oh, maybe it will hit your stop loss. It kick you out, then you go up. So maybe 5% is not enough. Maybe you need to set it lower at 10%. So you need to investigate for your own particular stock. Okay. All right. So that's the textbook method. They go by percent. Okay. But for us in our education to our students, we go by the what we call the ATR. Okay. Yeah. So we use the ATR range to determine how much we can put in here, and that will automatically adjust for volatility. All right. Okay. All right. So yeah, so that's the way. Okay. Now I see another interesting comment here. All right. So from Ying Kian, someone always look at the chart to determine his entry and exit point. All right. Okay, I'll comment on that. Okay, so I note the question. I will talk about that. Okay, and I'll talk about that when I cover the next few slides. Okay. All right. So on the strategy on how to exit, are you clear? Okay, let me just add a few more points there. So your entry is here. Your entry is here. Then you also have determine. Let's just say, for example, I want to exit here. Okay, I want to exit here. Stop loss. Right. So the distance between this and to this is your risk. Okay, risk. Okay. So with that, you can use your risk to determine how many units you can buy. Let's just say, for instance, I want to buy at 10 ringgit. All right. I want to exit when it reached to 8 ringgit. 8 ringgit. So how much is my risk? My risk is 10 minus 8. 10 minus 8, right? So $2. $2. If I buy one lot is 100 units. So it'll be 100 times 2. I'll risk 200 units. It's a 200 ringgit. So let's just say, so you can adjust. If your risk, you only want to risk 200 ringgit, then you can buy one lot. If you say that, hey, my capital is very big, I am okay to risk 400 ringgit, 400 ringgit here. So then you can buy two lots. You can buy two lot. So you use that to adjust what is your risk. And that ties back to the risk which we have mentioned earlier. Okay, all right. Okay, so then have a stop loss. Okay, so we have covered this point. So review the big picture, not the price. Okay, now, so hang on, let me see. Okay, all right. So this is, well, the slide from one of our earlier presentation. What really drives the stock price? Okay, so everything that you do, some of you go and research a company. Hey, what is the PE? How much company make? Who are the dato there? Okay, and then what is this company business? Or what is the latest contract they've got? Are they into the data center business? Did they secure a new contract to build highway or whatever? All that, everything that you talk about, all those things are actually under this category. Hang on, under this category. Oops, cannot change color. Under this category. Hang on, let me just under this category. Everything that you research about the company is all under this category. Okay, company fundamentals. This one. Oops. Okay, hang on. My slide jump. Okay. Yeah, everything that you research is under this category. And you can see here, this is just a ballpark number. So whatever you research can only contribute a 30%, well, to what actually drives the company stock price. Where are the others? So you can see industry and sector trend. Okay, what does that mean? Let's just say, for instance, right now, what is the hottest project industry that is that is propelling good companies in Malaysia? Can anyone tell me? What is the hottest business that is propelling all this? Data center. Okay, right. Okay, hang on. Okay, AI data center, build the hyperscalers and so on. Okay, so for those who do not know, right now we are talking about AI. Every day also you use AI to, well, to help you in your work or to ask questions or whatever. So all this AI, okay, whatever you ask the AI, your information will be sent to a place which we call data center. Okay, data center where they have all the massive computer, a lot of memory there. And this data center is built, it's like a really, really big hall or even big building, looks like a factory. Okay, so right now, the hottest thing in Malaysia is they are building all these data center in Malaysia. Malaysia, of course, is not the only place, but in the Southeast Asia or even in this region, Malaysia is one of the best place to build. All right. Why? Okay, that one you need to do research. I won't go to the story. Okay, so the industry is also contribute. So let's just say, for instance, I'm interested in company A. All right, company A is into data center. Even though the company A may not be very good, their management may not be so solid, but just because they are in this industry, okay, they will get contracts and things like that. So all right. So maybe they are not so, okay, they are so here. Hang on. So maybe they are so here. Okay. But because they are in a sector that is doing very well, hey, you may actually see their stock price going up just because of that. All right. Okay. Then the next thing is overall macro sentiment. You can see here, this one drives even slightly more, well, higher contribution to the stock price, 40%. What does that mean? Let's just say, for instance, you have a company that is doing very well. Okay, good management. They save costs every year or really run well. Nice. Okay, they don't borrow so much bank money from the bank. Very well run. Okay, excellent team. They do a lot of research. They come up with a lot of new product. Okay, good. Okay, then they are also in AI, which is the trend right now. Okay, but the macro sentiment, there's a war. Okay, there's a war. Okay, bad. All right, there's a war right now. Then oil price is very high. All right, so the energy cost is very high. Then because of that, maybe interest rate also go very high. So the cost to build data center now is very expensive already. Okay, so because of this, the overall sentiment, macro sentiment, can actually overpower all the good things from here, all the good things from here, then in the end you see your stock, hey, very good stock, but actually it's coming down. Okay, very good stock, but actually it's coming down. So why? Nobody knows why. Okay, so the actual why is this macro sentiment. Okay, so likewise, what happens in the 2022, like what I've shown you earlier. So in 2022, okay, right? So let me just cancel this and let's show you. So during this period of 2022, okay, so a lot of companies don't do very well. Why? Because the interest rate actually went higher and higher. Initially was triggered by US. US actually raised their interest rate. Then after that, a lot of countries also raised their interest rate as well because inflation is high. They want to control inflation, right? Yeah. So a lot of companies don't do very well. Okay. So even for the greatest, strongest company in the world, even if you look at US, all those companies like Microsoft, Google, Amazon, okay, they are making money every month after month, but their stock price actually come down. Likewise in Malaysia, you have good companies, but actually still goes down. Let's just say, for instance, if you look at let me just cancel this first. Okay, all right. So let's just say, for instance, if you look at companies, good companies, like maybe public bank, okay, some of your favorites, okay. Okay, hang on now. Why is it not refund? Okay, correct. Okay, so during this period, you can see 2022, actually it dipped a little as well. You can see it dip a little. After that, then recover back. Right. Yeah. So macro, the macro sentiment here actually drives a lot of things. It can overpower many, many other things. So whatever you research on the company is only 30% of the factor that drives the company. Right. Yeah. So anyway, yeah. So have an exit plan. Look at the big picture. Right. Okay. So I want to just go a bit more. So evaluate new information, learn about the business, the industry, the threat to the market, and so on. So you have to read more. Okay. Then another one is a lot of traders and investors. If they buy at 10 ringgit, okay, they buy at 10 ringgit, they are obsessed with this 10 ringgit. If the stock price goes down, they really cannot let go of this idea of 10 ringgit. They want to wait until the stock recover back to 10 ringgit. Then only they say, okay, now I can exit. All right. But if the stock recover back to 10 ringgit, what happens to them? Will they exit or will they keep? I'll ask you. Okay, tell me. If the stock goes down to $5, then after that, it managed to recover back. Okay, when the stock was going down, they tell myself, hey, oh, please help me. Okay, they pray to their whatever beliefs they have. Oh, please let the stock recover back to 10 ringgit. Then actually it went up to 10 ringgit. Their prayers were answered. Do you think they'll exit or not? Tell me. You can write in the chat. Will they exit at 10 ringgit or not? Okay, all right. So I have one who says they want to get out at 10 ringgit because their prayers are answered. Many actually think the other way around. Since it can go up to 10 ringgit, now all my prayers has been answered. I forget about my prayer and say, hey, what if you can go up higher? So they are obsessed with their entry price. Okay, yeah, okay. Basically, they're just thinking about this 10 ringgit. They wouldn't want to sell at any lower price. Okay, at any lower price. Okay, and then even if you are telling them, okay, let's just say for instance, now you know this, you can talk to your friend, hey, please sell stock A, you already lose so much money. What do you think they will tell you if you go and advise your friend, hey, please sell this, you lose it, you're already losing so much money. They'll tell you, I've already lost so much, how to sell? It's so painful. Does that sound familiar? Has any of your friends told you that? Or even you tell yourself that, hey, I've already lost so much. How to sell? Okay, how to sell? Does that sound familiar? Okay, so they are not willing to lose, right? When they get a chance, because they pray and then now they got their prayers answered, go back to 10, they still won't sell. Now their whole mind has changed already. Yeah, so please look at the big picture. If the stock ever comes back near, even if it doesn't come back near, please sell, exit already. Look at the big picture. If the macro sentiment says that, hey, things are not good, Okay, and then just by sheer of chance or luck, you get your price goes back to whatever level or even come back to $9, please sell them already, right? Because the macro sentiment or even the industry sentiment is still there. Okay, talking about industry sentiment, what happened to the glove industry? Okay, so I mentioned about glove company down, right? If you don't remember, let me show you glove company. Okay, all right. Let's just say for instance, Supermax. Okay, Supermax. What happened to it? You can see here. All right. So drop from nearly 10 ringgit down to $2.60. Sorry, not $2, 26 cents. Uh, okay. Malaysia, very important rubber producing company. All right. During the COVID actually last. Okay. The height, of course, was in 2020. By 2021, the vaccine has just started to roll out. I think by only 2022, things slow down. But look at this. Even before 2021 starts, even when the COVID is still at its peak, and then there's still a lot of death, unfortunately, happening around the world. You can see the stock price for Supermax has already started to come down. What happened? Right? Don't they need the rubber gloves at that point? They do. All right. I mean, hospital cases are still very high. Everybody are still very concerned about hygiene. Okay, but then what happened? So for that, you need to know what has happened to the industry. All right. Yeah. So Malaysia was the first to catch up on making glove and make money. So you can see stock price goes up. Okay. But Malaysia is not the only one. After that, China also start making glove. All right. So if you do not know, you say that, hey, it will go up, it will go up, it will go up. Okay. And you hope that price will actually reverse up and go back to the $10. All right. If you do not know. But if you know the industry, you know that the industry, Malaysian industry now has competition from China. All right. And as you know, once China is into one industry, they will not let go. They will bite on it and they will not let go. Even US is afraid of them now. Last time in China, they are not good with. Okay, sorry. Last time in China, let me just think. They were not good in manufacturing. Then they started doing manufacturing. Now they are the center of manufacturing for the whole world. Okay, then likewise, they were not doing textile. Okay, they were not into textile. I think India, Bangladesh went to textile. Then now they're making garments for everyone, everywhere in the world. Okay, now the next thing they are going after is what is the next industry that China is going after now? Anybody knows? Anyone? Come on. So anyway, as investors and traders, you do need to know, hey, what's the latest trend? So like what I mentioned here, hey, what is the overall macro? What's happening in the market? Okay, what is the industry? What is the sector? Robotics, making memory chips. So last time, AMD, Intel were the leading companies in the world, right? So now, okay, of course, we have the TSM, okay, Taiwan Semiconductor that makes chip. Okay, but then China now is also catching up, and US is really afraid of them catching up. So US actually tell the manufacturer who makes the machine to make the chips to stop selling to China, and this company have to comply. Okay, next, then China is also starting on robotics. Last time we talked about Japan making robots for their industry, for their factory, making cars. Now they are also into that already. Okay, like what Key says, they make GPU, they make CPU, TPU also. Okay, all right. Memory, they are even into quantum computing. All right. So you must know what's happening in the market. Otherwise, if something goes wrong, like the glove industry, you really do not know it. You're still holding on to stock, hoping that you recover. Okay. Right. So what does it take to be a consistent investor or trader? Okay. So first is uh, your skill. Okay. Let me just flip back to my first slide. My first slide here. Okay. So your skill in selecting the right stocks, your skill in determining what is the right the right timing to buy by looking at chart and whatever. Your skill in using the leverage instruments or even the particular instruments and all those things. Okay, that one stays. What you need to do is to improve your protect. Okay, so now I flip back. Okay, so what we need is you need a discipline, okay, to protect against all of those three mistakes that I've shown you. Okay, so your discipline must have a structure. All right, you must have a defined process for you to where to enter, where to exit your stop loss. Okay, either the system stop loss or your mental stop loss. Okay, you tell yourself, hey, I must exit there. And then your position sizing, which I've mentioned, how much to buy. Don't buy too many. Don't do buying too little. Stock goes up, you still don't make money. Buying too much, stock goes down, or you lose big time. All right. So you must have a structure. If you don't have a structure, please go and look into how you can learn this. You can read books, you can study on your own, or you can also come to us Beyond Insights to learn how to do this. All right. We teach a lot of students on this one. Okay. Second is you must know your above all, market is not your enemy. Your worst enemy is yourself. Okay, so psychology or mindset. Okay, you must have the mindset of a trader or investor. All right. So if you can read books about how Warren Buffett thinks, how all those famous traders think. Okay, resist. Okay, recognize and resist the urge to average down, oversize, and holding on to losers. Okay, all right. Then the last one is you must have a consistent approach lah. Whatever you do, okay, you must apply to everything. Just so you don't do like what I've mentioned here. While you feel happy, you can buy more. You don't feel optimistic about this stock, you can buy little. In the end, what happened? The one you buy little actually went up. You make little money. The one that you bought a lot, thought you have a lot of confidence, actually went down. So no consistency there. So please apply the same rules to every time you enter or manage your portfolio. Okay, then okay, so yeah, so what does okay, so in whole, we have this framework which we always teach our student. So we call this the SVS framework. All right. Whatever framework you have, even if you don't learn from us, it must be systematic. Like what I've mentioned just now. You have a process, okay, you know which one to select, how much where to enter, okay, when to enter, and so on. Right. Then okay, so that's systematic. The other one is versatile. Okay, so there are some traders or investors, they can only make when the market is doing very well. Wow, okay, doing very well, then you can make money. Okay, so everybody can do that. If market is doing well, even the auntie uncle on the street also can do well. So that's not the sign of a good or competent investor or trader. What you want is you want to be versatile. Market do well, you make more money. Market don't do well, you can also make money. Or okay, you can also make money. So you want to be versatile. You can manage different market. All right. Then the last one is this is what I've been talking all the while. Whatever you do, you must have the safety in mind. So this is not personal safety. This is safety for your portfolio. You must know how to manage. Okay, this is the points. You must know how to manage your portfolio so that you don't make those three mistakes that I've mentioned. Yeah, and all this, above all, and all this, you have to have the right mindset, psychology, the right mindset of a good trader or investor. Okay, so this is what it takes to do well in your investing. Okay, all right, yeah. So then, yeah. So with this, you'll be sustainable. You'll grow your capital. I can see, then like a tree growing. Okay, let me just see. Okay, all right. So at this point, I will just pause. Okay, let us enter into the next 15 minutes for Q&A. Right, I can see from the Q&A, right, okay, there's a question here.
All right.
Looking at today's market, are there any mistakes you are seeing investors make more frequently than previous years? Okay, and what should investors be particularly cautious about right now? Okay, very good question. Okay, I'll just park it to the side here. Let me show you a chart. Okay. Okay, and this is happening right now. This is happening right now. Okay, let me show you. Okay, anybody knows about KOSPI, okay, or the Korean Stock Exchange Index? KOSPI, yeah, this is a Korean Stock Exchange Index. Okay, all right. So this KOSPI. Okay, since when? Let me just see. Since the height and since the heat of the AI, okay, AI, all right. There are some very early investors and traders. They already know that memory is actually the very important component in AI. All right. So of course, the CPU is also important. Okay, what NVIDIA makes is also important, and so on. Okay, but memory is also another very important one, and it is even more important because there's only limited number of memory companies in the world that can make the memory for AI chips, for NVIDIA, and so on, for AMD. Okay, and Korea actually houses one of the largest there. Okay, there's actually many, the Samsung, SK Hynix, and so on. All right. Yeah. So because of that, look at the Korean stock market index. Okay, let's just say, for instance, if I assume that they started from here, 2000 in 2000. Okay, hang on. Let me just measure. Oh, go all the way up to the max. You can see here, it is 200%. Excuse me, it's 200% increase in their portfolio, right? 200% increase in their portfolio. All right. So that was the craze of driving all the way until June this year, just two months ago. Lah. That's right. Actually, 1 month ago, June this year. Right. So now we are still in July. And then look at what has happened to the market. Fall down. Fall down within how long? Hang on, let me just see. Fall down within 29 bar. Okay, I would say nearly 1 month. Okay, 1 month drop. The stock market has dropped to 38%. Okay, so this is the biggest mistake. Okay, that is happening in Korea. And looking at this, you can imagine a lot of Korean investors has actually lost big time. Not everybody enter here. Some enter here, some enter here, some enter at the height. So those who are there lost big time. And what is the problem? Okay, if you look at the three mistakes that I've mentioned, they have no exit plan. Okay, let me just go back. They have no exit plan. Okay, I go back to this. Okay, believe that you always come back. All right. So when market drop a little bit, they say, "Oh, don't worry, you'll come back." Drop this much, they say, "Oh, don't worry, you'll come back." Drop this much, don't worry, you'll come back. And some are still holding at this point. All right. So they make mistake number three. No clear position sizing. Those who lose the whole family savings, whatever, which I believe there's many. On average, according to the report, I think I can't remember, 20% of Korean investors, they get hit with margin call. All right. Yeah, around 20% hit with margin call. So it means when you go out in Korea, ask them, are you in the share market? They say yes. Do you have margin call? Margin call means they borrow from the broker, and then the broker now tell them, hey, I need to sell you to liquidate because your account has gone down. Right. So they have margin call. So 20% of them actually have margin call. And of course, many of them lose a lot of money. All right. Yeah. So, and at the end of the day, okay, so no exit plan. Okay, and then there's this hoping that you still go up. All right. So to me, that's the biggest mistake. And another mistake, of course, they don't even know what they're doing. All right. They see the market go up, everybody buy, they also buy. And what if they buy at the wrong time? Okay, what if they buy here? Okay, what if they buy worse still, even here? All right. So you do need to learn. There's actually proper strategies where to buy, and then of course not everything will work out in your favor. The strategy will also tell you, hey, after it drop, what are the signals that you need to see so that you can exit. All right. So please learn all this. If you're learning on your own, these are the things that you need to learn. Okay. Is there any chance for delisted company to be listed again? Possible, but don't, if you are holding this kind of thoughts because you're holding the stocks there, I don't even think about it. Like what I've said, move on to a winner. Don't just give up on your losses, sell it, cut your losses, cut all your hope for that. Please move on to the winners. That is actually a more better, surer way of gaining success in the stock market. Okay, so don't think about companies that can do the U-turn. Okay, so in our education to the students, we teach them to see what we call this, okay, not we call, okay, the home industry call this, the trend. All right. Trend goes up, good. Trend comes down, bad. That one sounds very common sense, right? But look at this. Trend comes down, people still want to hold. So it is not as common as you think. Common sense is not very common. All right. Let me answer the one question which I missed earlier. Okay. 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 So from Yin Ken, I hope you're still around. Okay. Someone always look at the chart to determine his entry and exit point. Correct. Yes. Now, out in the market, there is two main class of investor and trader. There is what we call the fundamental analyst, FA, and there is the technical analyst. All right, let me explain what they are. Fundamental analysts are people who look at, well, most of the time, they look at all the financial accounting. They go and check about the company, whether they're making more money, what is the business they are, what is the PE ratio, what is the debt ratio, and all those things. Okay. Something a little bit like accountant, but you don't need to have an accountancy degree or competency to do this. You can actually learn. All right. So they are fundamental analysts. There are also people, they are called technical analysts. They look at the stock chart. Okay. And some only look at the stock chart. They don't even care about that, the fundamental analysis. Okay. So those are called technical analysis. Okay. For us, we believe in two. So we combine two. So you combine two kung fu, then you are even better, right? So for us, we believe in two. Right. So you look at the company fundamental, but you also look at the timing, the chart to decide your entry. And to us, that is actually good. So good companies, sometimes they go up, sometimes they go down. So even when the stock is going down, you look at it just like what I've mentioned in the 2022. All right. A lot of stocks around the world go down because of high inflation, high interest rate. All right. But the companies are still making money year after year. So if you buy at that point, maybe after you buy a month, 2 months, 3 months, and within that whole year, you're still losing money. So what you need to do is, it's a good company. Yes, it is in your buy list, but you also learn how to read the charts so that you know the best time to buy. So yes. Okay, where was the point? Yeah, so yes, many investors and traders now they no longer focus on one single one. They learn both, and they use the timing, okay, the chart to actually decide on their entry. All right. So for those who do not know or find it, hey, this is something new, please go and learn. All right, there's a lot of resources around in the internet, or you can read books. Okay, or you can even join courses like ours. Yeah, go and learn about this. It will actually help your selection and your timing by a lot. Okay, all right.
All right, I see one question from Zakaria. He's asking that, I've been lately using subscription-based AI agents and bots for my buy and stop price decisions. So it has been great so far with great time saving and less stress on me. But since my experience has been short period of 3 months, is this advisable to continue for a longer run?
Okay, all right. Yeah, thanks, Shane. All right, so my comment is, okay, hang on. So my comment is, now when you use, okay, so there's a lot of AI facilities or AI tools. So you need to know what are the tools that you are getting. Okay, I will classify into three main categories. One is what I call a black box. You don't know what's happening. You ask AI, what should I buy today? Then pop, they tell you stock A. Why? Don't know. Maybe it gives you some reason, but you also cannot understand the reason. So that's what I call black box. So to me, I think no, don't go for black box. Whatever you buy, you should also understand why, and you should believe why. Don't rely on the black box. Okay, so with that, then there's another type of tool which is like a screener. So they'll help you to screen all the good stocks, and they will actually tell you, hey, this stock is good because of this stock is good because of that, whatever. So that one you can use the tool, but still, I would say also learn on your own, so that you can do with or without, but the tools make it faster for you. All right. So I would say I am an advocate of own knowledge. You must have the knowledge. Then the tools just help you only. Without, if the tool comes out with some wrong recommendation, you know it's wrong. Okay, like for us, we are now doing a lot of vibe coding to program our stuff. So vibe coding using AI. So as I use the vibe coding, sometimes I tell it, hey, do this, do that. And I know some of the suggestion it gives are actually a bit wrong. Okay, but I know that. So I can use the tool, vibe coding tool very well. All right, I know when it's wrong, I know when it's right. Okay, so that's the second category. The third category are those chart-based tools. So they will actually analyze the chart and say that, hey, this is the point to enter, that's the point to enter. So same thing, I would say you need to know how to analyze the chart on your own, but using it will simplify your life. You'll make your decision making faster. So if it comes up with wrong recommendation, you know it is wrong. Like for instance, like this, it tells you, oh, now is the time to buy. Then you'll be laughing at it and say, hey, no, you are wrong, totally wrong. Okay, now is not the time to buy. If they say that, hey, over here is time to buy, then you know it's right. So at the end of the day, tools help you to speed up your process, make your life easy, but it should not replace your competency. I hope that's okay. That's clear. Then okay, I can see the next question. Okay. How can the unit trust be plotted in DA with indicator? So unit trust is, I think, more difficult. All right. Yeah. So your question is, unit trust normally it is not, because it is not traded per se. Yeah. So you cannot, I think in most cases you cannot find the unit trust. Okay. Now, so having said that, I know some of you really believe in unit trust. And what is a unit trust? Unit trust is you having a certain wealth of or money. You declare to yourself, hey, I don't know, and I don't know how to invest or trade, and I do not have the time to do that. All right. So you pass your money to the unit trust company, and then they'll manage for you. All right. If you know how to do it and you have the time to do it, I would say that you can actually take back the control of your wealth and then you decide what to do with it. Yeah. So then you can decide you can decide, let's just say for example, oh, you want to buy stock A because it's doing very well. Then you decide. Yeah. But if you do not know what to do, many people choose to put their money into unit trust. Okay. Are they good? Are they bad? You can look at their past performance. I won't comment on that. There's many unit trusts around. Okay, some are doing well, some are not doing well. Yeah, you can look at their past performance. Okay, right. Okay, there's another question in the chat from Amirul. Okay, for one who wants to start to invest, please advise how much capital you start with and what are the sector you should focus more. How frequent do you need to balance your portfolio? Okay, so we deal with a lot of students who come to us to start learning. All right. But your questions is actually, how should I say, test me into half. So on one hand, you sound like a beginner, but on the other hand, you also know the advanced concept of balancing your portfolio. So I would say, yeah, you do have, well, a breadth of knowledge. Okay, now first, on how much you should start the capital. Okay, so a lot of people will think that, oh, I've saved maybe 20,000 over the many years, or 5,000, okay, if your capital is smaller over the years. So what should I do? Should I put all inside? Should I put a portion inside, 10% inside? What to do? Okay, I will say if you are new, you will start learning. When you start learning, there will be a period where you discover yourself and discover your skill. All right. So during this period, our advice to our student is always please use paper money. A lot of brokers, they allow you to create like a fictional account, a training account where there's no money involved. You just look at the market and say, I'll buy here, I sell here, buy here, sell here. After half a year or 1 year, then you look back, oh, I make money. Then you know your skills is good. Or after a year, oh, I lose so much money. Luckily, you are trading in paper money. So please go through a period of practicing or realizing, understanding yourself and your strategy before you commit. After you have gone through that and you say that, hey, my strategy is pretty sound. Every month I make 2% or 5%. 1 year I make 20% or something like that. Then only you start putting your money. Even when you put your money, just because you're new, right? If you're new, just go slow. Maybe you just put some percentage. Then after a few months or half a year, you see it's growing, then you can put more and more and more. Right. Remember, the stock market has been there since the 1800 something something. Okay, more than 100 years already. And for the next 100 years, it'll still be there. Okay, like my sifu in the Beyond Insight was telling me, the stock market will be there even way after I'm long gone. So don't rush, don't need to rush. Make sure you know what you're doing. Go and practice and prove your skills out in the paper money. Then after that, start loading it a little by little. All right. Yeah, so that's a very general answer, but I think that answer is actually a very good answer to all our students and anybody who's new. All right.
All
How
right.
frequent? Sorry.
Yeah, sorry.
Sorry, Shane. Okay, I know time's up. Okay, let me just finish the last sentence.
Sure, sure.
How
Please go ahead.
frequent to rebalance your portfolio? That one depends on your strategy. Certain strategy. Okay, rebalancing, maybe you mean to say buy and then sell and then buy again. So that one depends on strategy. Certain strategy needs frequent buy and sell. They are short-term strategy. Certain strategies are long-term. You don't have to rebalance a lot until the stock goes down or whatever. Okay, so
All
with
right.
that, I've answered all
Yeah.
questions. Yep.
Thanks so much, Koot, for doing this segment for us. So now that we have learned the three mistakes that are very deadly that investor make that can silently destroy your portfolio. Okay, so let me just take over the screen control. Okay,